Hello, welcome to Trading Options with Patman Young. This is the first part. This is part one. There are going to be different segments because I don't want to do one shot. I want you to be able to go through different segments to rewind it if you miss something. So this is part one. And in part one, I'm going to introduce you to who I am and why I trade options and what options really is. So let's go straight into the second slide. Uh, how trading options turned my trading journey around. That is very, very simple. I used to be, or I began with Forex trading, stocks, and also crypto on Coinbase. So that is where I basically started, or I learned how to trade. And during this course, I found out that stocks trading is really good. Investing is much better, but there was a better options than trading stocks. Investing is something absolutely different. It's a long-term thing for me, but trading stocks was not really moving the way that I expected it to be. So I educated myself on options and started learning the hacks, how which strategies I could use. So I mastered it and I began with just 500 euros, and in a short period of time, I was able to really gain a lot of money in a very very short period of time. The fact is, buying options contract is riskier. Okay, it's riskier than buying shares. I mean, when you just buy the shares of the company. Okay, so that is stocks. So it is definitely riskier. At the same time, the return on options contracts are definitely significantly very high. Okay, they are very high, so you can gain a lot of money in a short period of time. But at the same time, options contracts are definitely riskier. Why choose options over shares? Why choose options over shares? Options contracts are bought because people think a company's share price might go up or might go down. You can profit in both ways, whether the stock goes up or down. You can profit in both ways. When the stock price is going up, we call that a call when you go into it for a call, and when the share price or the stock is going down, we call that put when it comes to options trading. We'll get into that different definitions of it. Buying options are mostly more profitable and cheaper than buying actual shares, okay, especially short term. And that one, it is something very important when it comes to options trading, okay. Option contracts are definitely cheaper. Buying option contracts, we gives you shares for a specific time, are definitely cheaper than when you go for the actual shares of the company. Okay, so but this one, after we will be breaking it down every slide, every episode, you will learn why it is this way. Let's go to the second slide. What's the difference between options and shares? Let me answer it here for you. Shares represent ownership of a company. They also lower risks because there is no limit to how long you can hold your position. That's why buying shares that represent ownership of a company, buying actual shares is better for long-term investment. Okay, because they lower the risk. Okay, but and you are more likely to never lose your principal amount. Yeah, because the risk is really low when you go for the actual shares of the company, and also you can hold it for a longer period of time. Okay. When it comes to options give you the option to buy shares of the desired company. Okay, listen carefully. Options give you the options to buy shares of the desired company or sell the contracts back into the market. Acquiring option contracts does not signify any ownership of that specific company. Options are more risky because there is a time limit in place, along with the possibility of losing your principal investment. That is very, very important. And I want you to go back or read this slide because you have to really understand this part. Shares are represent ownership of a company. So if you buy a share of Tesla, for example, then you own that actual share that you bought. Okay, and you can hold that share for a longer period, a period that you want. So maybe you want to invest in that. So you invested that money in that share that you own of Tesla, for example, and you want to hold it for 10 years. You can go for it. But when it comes to options, you don't really own the shares. Okay. You have a time limit on any contract that you purchase. Okay. You will have an expiration date on your contracts when it comes to options. That is the difference. Shares, you own it, okay? But when it comes to options, you don't own it because there is an expiration date on it. So it's like you are borrowing the shares. Okay, let's use this term for example, so that it becomes a little bit more easier. You actually don't own the shares, like when you buy the actual shares of the company. But when it comes to options, it is more like you are borrowing the shares, okay, for a specific time period. Next slide. What is an option contract and what is the option? An option contract gives you, listen, the right to buy or sell a stock at a specific price. That contract transaction must be completed before or on a specific date, otherwise known as the expiration date. I told you in the slide before, options don't give you the right to own the actual shares, but because there is an expiration date placed on it, so it means that you are basically borrowing the share for maybe 1 week, for 2 weeks, for a month, for 3 months period. So this is what this is what options really is, and because there is an expiration date on it, it is much more riskier than buying actual shares where you don't have any expiration date. So if, like, for example, you buy an option, a contract, and you expect the share to go to 5, and right now it's at 4, but it doesn't reach the 5, then it means that maybe you will not reach your goal to break even and all that. Okay, so we have to understand this. The last slide and this slide, I will recommend you to go back, and always. That is why this course is also video based, so that you can always rewind back. And if you don't get something, you can always rewind back. And also don't forget that you can always contact me. The options that comes with each contract purchase gives you a right to buy 100 shares of a company per contract. 2 contracts equals 200 shares. Or you can sell your contracts back to the market, hopefully for a profit. And that is where we gain our money at. And I hope you get this point. The option that comes with each contract purchase gives you the right to buy 100 shares. So it means that where I was able, like, let me go back to this slide so that you get it. Shares represent the ownership, right? So the shares gives you the right to buy a part of the company stock. So maybe let's use Tesla, for example. So I want to buy shares of Tesla. So I bought 1 share of Tesla for 500, just for example reason, $500 or euros. In the other hand, with that same 500 euros or dollars, I can buy around 100 or 200 or 300 shares of Tesla when I trade options. So like where I was just spend 500 to buy just one share, when it comes to option, I can use that same 500 to acquire maybe 200 shares or 300 shares or 400 shares. And that is what is very, very lucrative. But at the same time, it's riskier because you have an expiration date placed on it. Okay, so options gives you the possibility to own more shares with the same money that you may go normally for actual share buy, but when it comes to option, you can buy with lesser money more shares of a company, but those shares don't belong to you because it's basically you have borrowed it for a specific time period, and you are hoping that these shares that you have bought, whether it's just one contract equals 100, two contract equals 200, three contract equals 100. So you always have to multiply the contract times 100. So the actual contract that you buy will determine if you will gain profit. And of course, we only trade with a plan. Trade with a plan. If you trade without a plan, you are putting yourself into risk of losing your actual investment. So always trade with a plan and don't go aboard of your plan because you become greedy, because you are gaining something. Don't become greedy. That is one rule that I'll always repeat in this course. Okay, so now let's look into option contract basics. We have a call, which is a bet that the stock is going up. We have put, a bet that the stock is going down. So basically, if we want to go into, okay, we are expecting Tesla to go up, so we want to enter a contract, an options contract, then we'll go for a call. If we are expecting that the stock that we want to invest in is going down, then we go for a put. Okay. Then we have the bid price and the ask price. Bid is the lowest amount the seller is willing to sell a contract for. Ask is highest amount a seller can sell a contract for, and that is who we are trading against. So basically, bid and ask is where you can negotiate with the market and be able to purchase a contract, an options contract. So the bid price, maybe the bid price is, let me give you an example. Maybe the bid price is 3, but the ask price right now is 5. The seller is not allowed to go below the bid price, and is not allowed to go above the ask price. So the bid price, for example, we choose 3, and the ask price is 5. Between 3 and 5, there is a 4, right? So we can negotiate with the seller. For example, we negotiate 4. So if he accepts it, then we will receive that contract, okay, that we want to buy. If he doesn't accept it, then we have to maybe go for the highest price, or we have to go for the bid price or the ask price. But in between, we can always negotiate with the seller, okay, to get into the contract, or to be able to get the contract. And then we have also the strike price, the number you believe the stock will be at by the expiration date. And that is very, very important, because that is why you need a plan. Because before you enter any options trade, you have to have a plan. You have to have an expectation. You have to be strategic about what you are purchasing. So before you purchase an options contract, you go into your trading plan and you look, okay, where are the indicators showing me where this price is going to move to? So maybe, let's say, for example, you are expecting the price to be at 120, Then, so your strike price, you choose a strike price of 120. I'll give you an example here. Let's use this for example. The stock that we are having here in this example is ETOP, okay, ITUB. The broker here is Tastyworks. It's one of the brokers that I personally use. My main options trading broker is IB Interactive Broker, which I recommend. My second is Tastyworks. Tastyworks is great when it comes to options trading. I'll recommend it to anyone who is who wants to trade options, and also definitely they're my main broker, Interactive Broker. Interactive brokers. So let's use this for example, and this is aftermarket because the market is closed, so that's why it looks a little bit different. But and in all, it looks the same. No matter what kind of broker you choose, this is what we call an option chain. Okay, this what we see here right now in this screenshot is an options chain, and this is how it looks. No matter what kind of broker you choose or broker you want to trade with, it always looks the same. Okay, the build is always the same. In the middle you have the strike price. Then on your left side you have the call. On the right side, you have your put. So the call, we expect the price to go up. The put, we expect the price to go down. So in this example, okay, we are going to choose. I am expecting the price to move to 5.5, right? The prices might be maybe at 4.5 because in the money will come to that. It might be at 4.5 right now, and I'm expecting it at the expiration date of 16th April 2021. The price will be at 5.5. So I will go for the strike price 5.5, and now I have to negotiate to be able to purchase the contract. I have to negotiate with the seller. And right now the bid price, and we have the ask price and the bid price here. On the call side, the bid price is 0.01 and the ask price is 0.05. So I have to negotiate with the seller a price which is acceptable to him. So what do? I will rather go not for the 5 because it might be too high, and definitely the 0.01 will be too low for the seller, which he will definitely not agree. So I'll look for something in between. So I'll maybe go for 0.03. Okay, so when the seller accepts the price that I have offered him, then I will be able to purchase the contract, and that means that my price was accepted and I was able to receive the contract. So if I purchase maybe two of this, because we said that one contract is equals to 100, it means that when we come to this one and I choose maybe, okay, let me just go for the ask price. Okay, we'll say that I'll choose the ask price, which is 0.05. Then I have to multiply this price times 5. So times 100, times 100. So it means that for this contract, I will pay $5. Okay, $5 I will have to pay for this contract to be able to get into the market, because we said that one contract equals 100 shares. So I have to multiply the ask price or the bid price with 100, okay, so that I'll be able. So this contract, 100 shares, will cost me $5. So this is why we say that options trading is cheaper, but at the same time it's riskier, because who knows if at the expiration date the price will go to 5.5. That's why it is very, very important to have a plan in place and know what you are trading. So I just want to put this first part a little bit short. I want to cut it a little bit short because otherwise it will be too long. I hope you were able to pick it up. If not, always rewind, go back, And don't forget, on patmanyoung.org, you can always book a one-on-one session and have a one-on-one session where I will teach you accordingly on a different scale. Don't forget, the next episode, we'll be going more into the contract, a contract breakdown. Okay, I'll be breaking it down for you. So go for the next episode. That is part 2. Thank you for watching and see you in the next episode.